We will now delve into the speculative nature of investing and predominantly focus on contract for difference. We will go through the pros, the cons, how CFDs actually work, and how best to use them when you are speaking to clients rather than overexposing them using CFDs as a tool to um, manage risk, take advantage of short term opportunities as well as hedge investors' overall portfolios. Okay, when it comes to a CFD, a contract for difference in essence is a cash settled futures contract. It's a contract between two parties, usually a buyer and a seller. It's usually between the buyer, which will be the likes of you and I, and then the seller will more than likely be a market maker or a broker, whoever's allowing you to take out the CFD contract. Now, they have become a popular form of investing for a lot of investors, as it does allow them to speculate on the movement of an asset, in particular an indices, a stock, currency, or a commodity, without actually the need of holding the underlying asset. Now that is crucial. As we look at preference shares or standard ordinary shares, if you were to buy any of those, you will have an equity stake within the company. And if the company is to go under, you are entitled to whatever residual assets will be left at the end. But when it comes to CFDs, you're speculating on the movement. You don't have to own the asset. So if, for example, you take out a CFD contract to go long, which means you believe an asset will go up in value, and so if the underlying asset goes up in value, you will make money. But if the underlying asset falls in value, you will naturally lose money. Okay, so CFDs are classed as a high risk investment. You can maximize your gains, but you can also maximize your losses. So, as touched on, some of the key features will be the fact that you can speculate on a rising and a falling market, going long or going short, and we will delve into that in a little bit more detail. The great benefit is investors do not need to hold the underlying asset. CFDs, like futures, are a geared product, so you will have to post margin in order to leverage your overall position. And yeah, you can trade in a vast array of assets such as stocks, indices, commodities, and currencies. When it comes to CFDs and talking to your investors, you have to make them aware that CFDs will only make up a fraction of their overall portfolio. They are a high risk tool, and depending on the investor's outlook or their objective, it's highly unlikely they're going to have a very high risk approach where they would want majority of their portfolio exposed to high risk. So a lot of CFDs in the past have come with the stigma of clients losing money because they haven't been managed or used in the most efficient manner. So when speaking with clients, we always make them aware that so we focus on building an income and growth based portfolio. We target companies with top dividend. We we select stocks which are top dividend payers. We balance the portfolio with a mixture of high and low beta stocks. But we do use the likes of CFDs to take advantage of short-term fluctuations in the market. We use the likes of CFDs to hedge and at times balance overall portfolios. Um, you know, make them aware you focus very heavily on risk management. Stop losses and limit orders are used at all times within all your positions. You keep an active eye on margin so that a client is not overly leveraged, which will expose them to, undue risk. So by understanding each, investment product as we go along, it's important to understand, the benefits as well as the cons and how it marries up to an overall investment strategy. So that obviously, as we go on and look at examples, you will get a better understanding of how CFDs can work with you as well as against you. Okay, now we're going to touch on leveraging and posting margin. One of the key features, not only with CFDs but other options and futures, is the ability to leverage. Leverage allows you to control a larger position size with a relatively small amount of capital. Okay, so it means minimal capital for maximum exposure. So while leverage can amplify profits, it can also increase the risk of significant losses. Now, there are a number of ratios out there. You can have a 5 to 1, 10 to 1, 20 to 1. It can be, at whatever level the market maker or the broker would want to allow. So if we were to use an example, if we use a 10 to 1 ratio, a trader can control a position worth £10,000 by just depositing £1,000 worth of capital. Okay, so he can control a significantly large position. If it was an equity holder, they would need to have £10,000 cash to purchase a stock. Okay, because they're owning the underlying asset. Whilst with a CFD holder, they don't own the underlying asset. They can just they can put £1,000 down and in turn control a larger position. Now, when we talk about margin, a margin is in essence the broker having to require the trader to deposit additional funds into the account in order to bring the equity back above a maintenance level. Okay, so if you are to open up a position, for example, they may require a 5% margin. If you are to open up a £10,000 leverage position, you would need to put down £500 capital. Okay, that £500 margin is seen as an element of security for the market maker. So that's how it works. Margin can vary depending on which platform you use. And due to new regulations, a lot of retail investors have to post a significant amount of margin in order for them not to take on too much risk and hemorrhage losses. Okay, so the margin requirements will vary from broker to broker. It is seen as a tool used by the market maker to add that element of insurance in there. Okay, we're just going to cover the terminology when we talk about going long as well as going short, also known as buy and sell. Remember, with CFDs, you don't own the underlying asset. That's the main important part. So if we do take a long position, we are speculating on the fact that the underlying asset, let's say it be Barclays, goes up in value. Okay, and we can take a contract out and we can buy a position, and we can, once we close the position, we will settle the difference. So for example, if we've taken out a £100,000 position in Barclays and it's gone up by 2%, we have made £2,000. Okay, and in turn that difference will be put into the account. But for example, if we leveraged a £100,000 position and Barclays went down 2%, we would have lost £2,000, and that naturally will be taken out of the account. So when we talk about going long, we're anticipating the share price to go up. Why would the share price go up? That could be based on, the market sentiment in general. It could be based on geopolitical events. It could be based on the fundamental analysis of a company. They may have had good results. The sector may be performing well. That's why investors are bullish and continuing to buy. But if we talk about going short, we believe that a stock price and asset price will go down in value. If it's going down in value, investors are not buying it, they're selling it. Why would they be selling it? Is it based on the fact that the data is bad, market sentiment is weak, there's a global economic crisis? Understand the reasonings why investors want to go long and want to go short. That will give you a reason of what to get involved in. So if we talk about a CFD going short, you're speculating in essence on the price of the underlying asset to fall. Okay, so if they do go short and the underlying asset falls in value, that's great. The difference will be settled and you will make profit. But if, for example, the underlying asset rises in value, you will naturally take a loss, and whatever you've lost will be taken out of your trading account. So those are just the basic reasons of going long and short. For me, it's more about you understanding why investors would be buying stock, why investors would be selling stock. Understand the reasoning behind that. Once you can understand the reasoning behind that, you're in a better position to potentially predict the market going forward. Here we've got a very a simple example of how a CFD works. Let's say, for example, we wanted to buy £100,000 worth of BP. Okay, so we want 100 grand worth of exposure. An equity holder would need to have 100 grand cash to buy BP because remember they're buying the underlying asset. Whilst a CFD trader using a leverage ratio of 10 to 1 would only need to deposit £10,000 into its account in order to control a £100,000 position. So if BP goes up 2%, the equity holder will make 2%, which will be the equivalent of 2K. Great. But a CFD holder will also make 2K, which is the equivalent of 20% compared to the initial investment of 10K. Okay. So that's great. Minimal capital, maximum exposure. That's what it can potentially do for you. Here now we'll look at what will happen if the opposite occurred. So everything remains the same. We're looking at 100 grand's worth of exposure. Equity holder needs to have 100 grand cash. A CFD trader will only need to put £10,000 down in order to control a £100,000 position. If BP goes down 2%, the equity investor will lose 2%, which is 2K. But a CFD trader will lose 2K as well, but that's the equivalent of 20%. That 10K goes down to 8K very quick. Okay, so it's very, very much a case of when speaking with your clients and potential clients, you reassure them that you know how to monitor margin. You know how not to overexpose them in too many CFD trades. Okay, that is going to be the key element. Risk management, of course, is important, but you don't want to be using CFDs as a tool to really transform an overall portfolio. It should be there just to benefit from short-term swings, short-term movements, maybe hedge investment portfolios, maybe average into certain equity positions, because you can use a CFD to average in to existing positions that you have in order to get out of that position a lot sooner and free up capital. Okay, when it comes to who trades CFDs, look, CFDs for a while was predominantly reserved for hedge funds, but then became actively used by retail investors. So it was open to the broader market. So retail investors, individual investors, often use CFDs to really gain exposure to different markets, stocks, indices, currencies, commodities. And as mentioned earlier, you can do so by having minimal capital in order for maximum outlay. CFDs are not designed for being a long-term investment tool. Equities is the route you want to go for if you are looking for that, based on the fact that CFDs do charge daily interest. You are paying brokers commission, so CFDs can, even though they are relatively cost effective, if you hold them for too long, they can be um, not the best options moving forward. So it is designed very much for day traders, swing traders. Um, if you're holding it for a short period of time, that's absolutely fine for retail investors. Professional traders, a lot of prop traders, proprietary traders who work for hedge funds or different asset management firms will use CFDs as part of a trading strategy. It allows them to be a lot more flexible when it comes to trading, so they can use both the speculative nature of it as well as for hedging purposes. Institutional investors are the banks, hedge funds, um, pension funds. They use CFDs for various purposes, it's mainly really to gain short-term exposure or managing overall portfolio risk. Market makers, they're one of the key financial institutions. Their aim is really to, provide liquidity to the markets, which is important and very vital. By having more buyers and sellers, allow for, um, you know, uh, more liquidity, so you're not susceptible to gapping or adverse price actions. So yeah, market makers also play a big part when it comes to CFDs. Okay, a number of the pros and cons attached to CFDs. We'll start with the positives. First and foremost, it is a leverage tool. As I said multiple times now, it's minimal capital for maximum exposure. So for a small amount of cash, you can control a larger position, which means that you can maximize on uh, profits. Okay, you've got access to various markets. CFDs have opened up the spectrum to get involved in emerging markets within regular equities, within indices, FTSE 100, DAX, Dow, for example, commodities, currencies as well. You've got the ability to speculate on the downside by short selling. So if you do believe an asset is weak and you believe it's going to fall in value based on XYZ reason, you can, in essence, gamble on that fact. You do not own the underlying asset, so you're not tied in to the company. You do have risk management tools. Risk management tools can also be used with ordinary shares as well. You can always use stop losses and limit orders, but we'll put it in for this example. So yeah, risk management tools are important. I class hedging as a risk management tool because it can help you protect against any adverse movements depending on the direction. There are low costs, especially if you're short-term trading, intraday trading. The costs are very minimal, um, and you've got a range of trading strategies, which we've discussed in the previous slides. When it comes to the negatives, there is a leveraging risk. We know for a fact that you may maximize your profits, but you can also maximize your losses, so you have to be very careful. There is naturally the inherent market risk attached to any form of investing. There is counterparty risk. When we talk about counterparty risk, that could be based on maybe the market maker or the provider you're using for your CFD contracts goes under, then your positions will be lost, especially your open positions. It can be difficult for beginners. CFDs is not a tool which should be taken lightly. Any form of leveraging tool should not be used lightly. Um, it is part of my final point, but overtrading and emotion does play a huge part when it comes to trading. You could be there trying to recover losses. You can be overconfident. There's multiple different factors for beginners to really grasp. The cost and fees can be an issue, especially if you're getting advice. depending on what the broker charges, that can be expensive, and overnight fees if you're unfortunately locked into a position for a long period of time. The fees can really add up. So these are the pros and the cons. I want you to be very familiar with them, as when you are speaking to your client, you don't need to oversell a product to a client. You know, they're more than likely going to be aware of what CFDs are. Like I said, at times it has come with a stigma of, you know, not being used effectively, and has lost them a lot of money. So you want to reassure investors that you really know what you're doing, what trading strategies you adopt. Why does it only play a fraction of their overall portfolio? How do you manage the risk? How do you manage margin? These are the elements you want to be focusing on, just to reassure investors that, you know, CFDs is not a tool just to make money from a broking side. Is there to help protect portfolios, and overall maybe minimize the risk of a portfolio.